you have savings that are compounding. And I'm not talking about what the bank offers, the savings rate. I'm talking about better rates that are found in investment funds. And have you ever thought about investing in investment funds? So this video today will cover the basics of investment funds, just mentioning the basics, and is also going to lead you to understand how you can start your investor journey in investment funds. Investment funds are very convenient, especially for a beginner investor, because it doesn't require much from you. All you have to do is deposit and understand, do your due diligence. It's important to do your due diligence to understand the company you are investing with, their past performance, their legitimacy, so that you know we're not losing the money. Making money is important, but what is most important is protecting and multiplying the money. So in this video, we're going to cover the basics of investment funds, and I'm going to show you a step-to-step guide on how you can get started on your journey in investment funds. And I know the most common and famous way to start investing in investment funds is through the money market. But in this video, we're going to go comprehensive into other kind of arrangement or packages or strategies that can earn you like really good returns that are even beyond the money market returns. So without further ado, let's begin.
So first off, let's start by understanding investment funds. What are investment funds? Investment funds, the best way to define it is to understand there are two ways to invest. When you decide to invest in a stock or a bond or one of these many asset classes or a particular asset classes, you can either do it directly or indirectly. So when an investor decides to invest in a particular asset class such as equity, there are two ways they can do it: direct investment or indirect investment. Direct investment is when an individual personally buys shares in a company, such as buying shares in Apple. But indirect investment is when now you want to invest in Apple or a technological asset, but instead of doing that or going for an individual asset, you buy into a fund that is going to invest in multiple assets. So you buy a stake in a fund, such as a mutual fund or a collective investment scheme, that allows you to not just buy one asset, such as Apple. You get to buy various assets. Could be Apple, buy into bonds. You buy into the various assets instead of just buying one asset or a few assets, like a direct investor. So let's say you have $3,000 and you want to use this $3,000 to invest. So one thing as an individual investor, you're going to look at maybe one stock. So you look at Apple, and Apple it's trading, let's say, at over $300 right now. So with 3,000, you're only going to buy at least nine, stocks or positions in an Apple stock or an Apple equity. But with the same $3,000, when you buy into a unit, let's say you buy into a unit trust, you're able to have your money your money is going to get invested in various assets such as the stocks. It won't just invest in one, it will go and invest in multiple, maybe also Meta, Microsoft, maybe invest in other local assets. And then from there, it will invest in bonds. You'll find schemes such as, cash. So that means that your investment has been spread across various assets vis-a-vis just buying one stock. So an investment fund just allows you to access adequate spread of investment vis-a-vis, if you went in as a direct investor. In Kenya, the most famous investment fund is a collective investment scheme. And the collective investment allows you to access the pool of funds and unit trust, that are used to invest in various assets. And one thing you need to understand as a investor in the investment funds, you never buy into a fund that is not regulated by the Capital Markets Authority and is being overlooked by the Central Bank of Kenya. Never do that, because that will be a company that has come. Every collective investment scheme based company must be listed under the Capital Markets Authority. That way, it's regulated. In case of any foul play, you can blow the whistle and you can actually have a good chance to regain your capital back. So now that you have understood investment funds, let us now look at the benefits of these collective investment schemes or investment funds in general. So one of the major benefits is that you get to experience economies of scale. Economies of scale is a term used in this capitalistic economy because this is when a company may experience cost advantages when it increases its production output or expand its operation. And this occurs when production rises faster than cost, spreading cost over a large amount of goods. So one thing companies usually get to is to at this point where they look at how they can double their profits, double their production while maintaining the same cost, the same operational cost or the same production cost. An investment fund allows you to experience economies of scale in investing because you get to experience different assets, you get to multiply your efforts by maintaining costs. Like now, if we go back to example of $3,000, you had $3,000 as an investor. When you go alone, you'll only be limited to buying one asset and getting, some type of result. But when you get into an investment fund, you're not going to just buy one asset, you buy several assets while, you're experiencing cost advantage because now you're buying so many assets with just $3,000 and you're able to get at least an almost guaranteed return with the same cost without extra charges. So it actually gives you that kind of benefit. The second benefit is diversification because when you buy into investment fund, like I explained, you're going to diversify your investment not just on one asset but on several assets, which kind of protects you. Because let's say if you bought into an Apple stock and something happens to the economy or something happens to the brand, you are going to lose all your investment or savings. So let's say, for example, recently we just experienced elections, and that causes markets to move in a certain type of way because of the economic sentiments. So if your money was on one thing and you were not very careful, you might as well lose your investments. Vis-a-vis, if your investment, some of the money was in cash, some was in bonds, you're kind of protected. And number three is you get access to a professional investment manager or investment management. So it comes with a fund manager because one thing you have to understand as a investor is that you really need to stay in touch with the market. Even if you just invest in one thing, like let's say you bought Apple and then you bought gold as a commodity or as a future, you've got to sit down and actually keep up with the markets. What's going on? What are the interest rates? What are the GDP? What's the inflation? What's going on? What are the sentiment in the geopolitical area? So that you make sure that the position that you took, let's say you took a long position, it means that you're going to have profits if you stay in touch with the market. But let's say if you open a position and something is happening to push, maybe you open a long position and something is pushing the market in a short direction or a bear direction, you're obviously going to lose your money. So one thing about being an investor is you have to stay hands on in managing your portfolio, managing your investment. But when you invest in an investment fund, you don't have to do that. You just have to put your money and you have an agreed range of interest returns. You go about your business. Annually, after a year, you get your money. Either you get paid twice a year, or depending on the agreement you have with your banker or you know your asset firm, the one that you choose. Number four, or is it number five? Number four, you get access to geographical markets. So you're just not going to just invest in one asset. You get access to geographical markets that are performing well around the globe, um, which may also be inaccessible to the individual investor if you just went to invest on your own. Another benefit is you get the benefit of regulatory oversight, and you also get like tax deferral benefits. because investment funds are not usually exposed to capital gains tax as an individual investor. Because when you go to buy an asset, let's say you bought Apple assets or you buy Safaricom or KCB, you get capital gains. Your capital gains should be taxed on the stock or even on the dividend. But when you buy into a fund, the only tax you are experiencing is the withholding tax, and that is a benefit right there. So now that we've talked about what are investment funds, by now you should be able to understand that and the benefits of an investment fund. Now let us look at the downside. What are the risks or what is expected of you that you may not really like or you may not, you need to know. So buying into an investment fund, or in this case in Kenya, a collective investment scheme, you will be charged an entry fee. And also, I mentioned fund managers. These are people that provide these kind of services are running a business. So at the end of the day, you're going to experience annual management fees that are needed to cover the fund manager salary, the technology that will be used, the research, the dealing, the settlement, and the risk management system, and to also like provide profit for this company. Also, as much as we're talking all this big talk with fund management, whatever, sometimes there's usually no guarantee that a professional management will deliver superior result, that especially during market volatility or market downturns, you're not necessarily protected just because you invested in an investment fund. Anything can happen, and the professional management may not necessarily deliver as promised sometimes, you know. So let's say if they're using even active strategy or passive strategy, sometimes it's not guaranteed, although some of the investment fund returns are often guaranteed because they will use passive investment strategies. But sometimes anything can happen and you have to be open to it, because investment equals taking risk. But these things are usually regulated and managed, so they are a bit more safe than if you just went naked into the market to buy a stock and you're not really like informed, or you're not necessarily, quite informed or skilled.